Hello everyone, it's Susie from Esoteric Trading Solutions. I hope you're all well. I hope you're living your life according to the way you want to live it. You're being kind to yourself, you're being kind to your family and friends, you're communicating to them, telling them how you feel, you're looking after your potty cats, your animals, being kind to your animals, always being kind to people in the world generally, just to make this world a better place when there's just so much horror and criticism and just negativity. Thanks, guys. I'll be talking about this. Thank you very much. Now, today I'm going to discuss how much cryptocurrency should we hold in terms of our overall portfolio. So there's different asset classes, different types of asset classes with risk and return, and obviously people will have a portfolio depending on their of their age. Obviously, young people have a different type of asset class portfolio to older people. And we'll just go through that. There's many different types of asset classes, but I'll mainly focus on the traditional asset classes, and then we'll add also cryptocurrency to the traditional asset classes, which will obviously change that risk return matrix. So what do we mean when we talk about asset classes, for example? As I said, there are the main types of asset classes that are seen are generally cash, debt, fixed income, or fixed interest as it's known, equities, property, and now the newest asset class is cryptocurrency. In terms of financial markets and fiat markets, there are many types of asset classes, and these asset classes can even be sub-asset classes or other types of asset classes, being commodities, foreign exchange, derivatives, private equity, alternative assets, and all sorts of things. Could even be high yield, alternative assets, whatever. But generally when we talk about the traditional asset classes, most people will think of these four, particularly cash, fixed income, equities, and property. And essentially any other mix will be an alternative of those asset classes. Now, obviously certain assets will exhibit certain characteristics and returns. Some asset classes are more riskier than other asset classes. So, for example, equities are seen to be much more riskier than, say, property. But again, it depends on what type of property we're talking about to the risk-return matrix of property. There's a number of different types of property within the umbrella of property. Obviously, there's a number of different types of equities within the umbrella of equities. Within fixed income, there's all different types of fixed income. So fixed income is pretty much an umbrella term. But, if we were talking about CDOs, collateralized debt obligations, these are very risky within the umbrella of fixed income. Or if we're talking, say, floating rate notes or high yield, these are riskier than just, say, sovereign government bonds, for example. But again, it depends on what sort of sovereign government bonds we're talking about. We could be talking about, say, emerging market sovereign government bonds, say like Argentina, which are the government's nearly broke, so they would be high risk. They wouldn't be considered vanilla sovereign government bonds like, say, Australia or the US, which are highly rated, and the risk return, the risk profile is very low, and the return profile is very low. So if we go to the next, slide, if you look at the asset class called total returns, and this came from Merrill Lynch, and you can even divide asset classes in terms of specifically to product, for example. So you could have US Treasuries, you could have the MSCI Emerging Market Debt Index, gold, as an asset class, global high yield, US Treasuries, REITs, which again is residential. It could be all different, particularly specific down to even the product. Okay, but we're just going to look at the main asset classes, not specifically down to the product, just to give you an idea of portfolio allocation and how risk return matrix change. Okay, so if we talk about cash can be 11 a.m. or 24 hour. It can be bank bills, it can be commercial paper, it can be floating rate notes generally, but people will define cash differently. A fund manager will define cash differently. Some fund managers within their terms of cash will say that bank bills should be in cash because they can be liquidated quickly. Some fund managers will say that, commercial papers for some of the biggest corporates in the world is still deemed as cash because they can be liquidated quickly. But again, some people will have different definitions of cash. So it's really important to find out what that definition of cash is, because the returns and the risk profile for cash can be, completely different too. Cash may not necessarily be cash as you believe it to be. One thing cash should be is highly liquid, but there have been situations in funds where cash was not highly liquid, and we've seen that over the past where people couldn't liquidate some of the assets that they deemed as cash because they actually weren't cash, okay? But generally, cash should be a highly liquid asset, and if a fund manager goes to cash, it should be as a defensive move, because obviously cash is pretty stable. You're not going to lose anything if you're in a term deposit. You're not going to lose capital. And basically, if you go to cash, you're getting out of generally a riskier asset back into generally a risk-free type of asset, okay? So if we go to the next slide, if we talk about debt and fixed income, again, this is an overall umbrella term. Fixed income can mean so many different things, okay? It can mean corporate bonds, government bonds, short and long dated securities, mortgage-backed securities, commercial-backed securities, fixed and floating, inflation-linked bonds, collateral debt obligations. Now, all these types of fixed income, they're all specialist products, and they can all have different risk return matrix, completely different, okay? Government bonds, as I said before, government bond of the US or Australia is not equivalent to a government bond, say in Argentina or Venezuela or somewhere else, okay? A mortgage-backed security is not the same as a government bond. Mortgage-backed securities can be very different within themselves. For example, some mortgage-backed securities, which is basically a special purpose vehicle of mortgages within that special purpose vehicle, they can have many different borrowers within those special purpose vehicles. And again, not all mortgage-backed securities are the same. Not all commercial-backed securities are the same. They often require specialists that run these mortgage-backed security funds, and so they're very specific products. And again, high yield debt can be completely different. So the risk return matrices can be quite different, okay, within the fixed income. Fixed income is a very complex area, and I've been a fixed income broker dealer most of my life. And fixed income can mean so many different things, from the very short end of the cash curve right out to the long end. It could be a 100-year bond or a 50-year bond, or an index inflation-linked bond or an index-linked bond or something like that. So again, it can be quite complicated, okay? If we go to the next slide, as I said, collateralized debt obligations, again, are not equivalent to government bonds, even though they can be rated AAA or BBB or whatever. They're basically a special purpose vehicle that will have a combination of different types of corporate debt within them, different types of credit card debt or auto loans or mortgage payments or whatever it might be. Collateral will be put up by the person that puts together the SPV. They'll get a rating from, Standard & Poor's, and then if there's any debt within that special purpose vehicle that goes broke, that CDO will actually get downgraded particularly, and that's what we saw in 2008, 2009. A lot of these got sold to the councils in Australia, and a lot of the councils lost a lot of money through these because there was a thing within the council bylaws where they could actually invest in AAA fixed interest product. The council thought this was okay, but they weren't purely fixed income like government bonds, for example. They had a lot of risk, particularly because they were a special purpose vehicle, and basically there was a special purpose vehicle where there was senior debt, AAA, mezzanine, and nano equity, and there was collateralized debt. So quite complicated, and a lot of councils got stung on this. When we talk about equity, we're generally talking, when we talk about an individual person, we're generally talking about public equity that's listed on the stock exchange. So again, if you're talking about your 401k or your superannuation, you're going to generally be invested in public equity that's already listed on the stock exchange, okay? Private equity is not actually listed on the stock exchange, all right? So generally most people within their super fund will be in a balanced fund, which will generally be invested in equities. Now, a balanced fund is considered generally 67% equities, domestic and international, 5% cash, say 15% property. The remainder is fixed income and some alternative assets. And obviously that's not considered. It's not balanced in the sense that you have a balanced fund, 25 for equity, 25 for property, 25 for this, and 25 for that. If you know what I'm saying. So also, most people will be invested in property. Now, it depends on people's age, of course. But, if we look at retail property, that'll be your prime residence that you live in. We know the risk of retail property. But all property is not the same. You can have commercial property, you can have structured property, you can have construction property, vacant property, mezzanine property, which has got equity type risk. So there's many, many different types of properties. But when I'm talking an asset allocation just for an individual, I will just talk about retail property, okay? Or you might be invested in REITs, for example, in some sort of structured SPV, special purpose vehicle that invests in property, okay? Now, the newest asset class is cryptocurrency, as we know. So let's call that the fifth asset class that we're looking at. And as you know, at the moment, there's well over 3,000 cryptocurrencies, coins and tokens in the market at the moment. And every day there are more cryptocurrencies being added, roughly about 100 or 200 every day. So there's a lot of cryptocurrencies, coins and tokens. And as Brad Gallinghouse said from Ripple, the CEO, he said in 2 years' time, 99% of these cryptocurrencies will be worth zero. And I believe that as well, because a lot of these cryptocurrencies don't have utility. They have no business case. They've got no clients. Often they're a hard fork of an existing technology, or they may not work, and there's no usability. If there's no usability of the token or the coin, then, you know, how are they ever going to make money in terms of the crypto itself? Some of these cryptos do have value, and they shouldn't necessarily have value when there's no business case and no revenue generation and no utility, okay? Within the cryptocurrency market, there are many different sectors and different industry, and of course, there's different types of technology. Some, do have problems, real problems that fit to cryptocurrency technology, and they have solutions, but most of the cryptocurrencies that we see don't. They shouldn't even be a cryptocurrency coin or token, and there may not be a necessary problem that fits to cryptocurrency technology or not. Utility is the most important thing. And again, not all cryptocurrency is the same, okay? There are many different types of cryptocurrency. It is a case by case. You have to really do a review of every cryptocurrency or token that you invest in, because it really is buyer beware. And, as I said before, and I'll repeat this again, 99% of cryptocurrencies, I believe, will be worth zero in a couple of years' time. Also, valuation is difficult, right? I've done a course on this, which will be coming soon, of 82 lectures on how to do valuation for cryptocurrency. And it looks at all the other asset classes as well, in terms of how to do valuation as well. And valuation can be quite difficult depending on the cryptocurrency itself and depending on the type of technology, okay? And, valuation is a skill set. Okay, people, work many years in finance and do many financial maths courses to actually do valuation. You get a certificate and, degrees and all sorts of things to be able to value assets properly, okay? So it is, to some degree, a science. And I guess with cryptocurrency, it is a buyer beware, because of most of the cryptocurrencies on the market today are going to be broken in a couple of years' time. It really is buyer beware. So if we look at asset allocation, what is asset allocation, okay? Asset allocation is an investment strategy that aims to balance risk and return by apportioning a portion of your portfolio according to your own individual goals, your own individual needs, your risk tolerance, and your investment horizon, okay? So effectively, it depends on also how old you are. So someone that's, say, 90 or someone that's, say, 50 or 60 or 70 is going to have a very different risk tolerance to someone that's quite young. So someone that's 70, for example, they're getting older, they can't afford to lose money. So their risk tolerance is going to be a lot lower than someone that's only 20 who has a very high risk tolerance, because they have time to recover. If they lose money in the markets, they've actually got time to recover. But someone that's 60 or 70 or 80 doesn't have time to recover. So their risk tolerance is going to be low if you're 60 or 70 or 80, generally. And, your returns, if your risk is low, generally, your returns should be lower, generally, as a rule, okay? So basically, asset allocation is, really looking at the assets that you're comfortable with, and also looking at the risk return that you're comfortable with. Also looking at what your goals are. Do you need the money now? Do you not? And basically, what is your time horizon? Now, how long do you have for these assets to generate a positive return? Rather than, say, being fully invested in, say, the equity market. Say 100% in the equity market, and yet the equity market sells off for the next 10 years. When the equity market does sell off, sometimes you can have returns being negative, and it takes a long time for those assets, those equities, to come back, okay? So the thing is, there's no perfect thing as asset allocation. Every individual will have a different mix in their portfolio according to their risk return tolerance and their risk return profile and their investment horizon, okay? The thing is, you need to find a balance between what you're comfortable with in terms of your own risk return profile. And this should be done, literally, as a minimum on a yearly or a semi-annual basis, okay? Because risk return profile changes, you need to constantly review the assets that you're in, no matter what they are, whether it's equity, whether it's property, whether it's cryptocurrency, whether it's bonds, whether it's something else, okay? Because obviously the returns can change quite dramatically, and an asset class can become very expensive as well, okay? You could have the property market going through the roof, which it has. It could triple, quadruple, whatever, and other asset classes may not move as quickly. So asset classes that you're invested in should be constantly reviewed all the time, okay? And individual assets should constantly be reviewed all the time. And that's pretty much what I do in terms of crypto land. Anything that I'm invested in terms of crypto land, I constantly review all the time. So if we look at traditional asset class allocation for most people, and I'd be saying generally in this situation for people, over 40, if you're young, you may not necessarily own a house, but most people might have a house that they live in. They may have a small cash deposit. They may have superannuation, which in America they call it, 401k or something, and it may be allocated across 35% domestic equities, 32% international equities, 5% cash, 15% property, 10% fixed income, and 3% alternative assets, which is 100%, okay? So as you can see, 67% of this is allocated to equities. Now, generally this is called a balanced fund, and most people will have their superannuation allocated in a balanced fund. But as I said, it's not a balanced fund in the sense that all the assets are not equally, all the asset classes aren't equally allocated in a balanced way, i.e. 25%, 25%, 25%. So again, as I said before, most people will be allocated in a balanced fund this way. And again, 67 or 70% of that will be allocated to the equity market. Okay. So if you look at the real, we break it up in terms of the real split, which we'll talk about, you'll find that most people have a fairly high position in property and equities, okay? Now, if we look at risk-return trade-off, government bonds, depending on the government bond, is fairly low. If it's, say, an Australian government bond or an American government bond, bank deposit returns are fairly low, and it goes up the risk. As you dial up more risk, risk dials up and return should go up. Hybrids, property, Australian equities as such. And obviously, crypto would be up here somewhere. So if we look at asset allocation for most people, let's assume this. You have a residential house that's worth $650, you have $10,000 in cash. Your superannuation or 401k, you might have $150,000, okay? Domestic equities, you might have 35%, as I said. Foreign equities, 32%. Cash, 5%. Property, 15%. Alternative assets, 3%. And fixed income, 10%. So 100%. So say you have your total assets at $810,000. That's your total assets. And this is the allocation, okay? And again, this is assuming that you say a person between the age of 40 to maybe 70, right? So if we go to the real allocation, we've got property, which will be obviously your house, but also property that's been invested in your superannuation. So we find that we actually have, say, 0.83 property, cash 0.02, domestic equities 0.06, foreign equities 0.06, alternative assets 0.01, and fixed income 0.02, which is 100%. So if we look at the conservative assets that we're actually sitting in, we find that property, cash, and fixed income, which is 705,000 of the 810, is sitting in very, very conservative assets. So 87% of our real allocation to asset allocation is sitting in very, very conservative assets, where the risk is fairly low and the return generally will be fairly low, okay? So this would be an allocation, generally it should be for someone that's probably over the age of 58. Anyone under this age group should have probably a much more, a bit of a higher risk tolerance for a higher return and a higher risk. But this is an ultra conservative portfolio because most of the assets that you're sitting in are basically sitting in property, okay, including your superannuation assets, okay? So the question is, how much allocation should you have to cryptocurrency in your overall portfolio? And the thing is, you really need to look at how old you are, because cryptocurrency is higher risk, higher return than all the other asset classes put together. But again, in saying that, not all cryptocurrency is the same, okay? We can't view all cryptocurrency the same because, as you know, there's 3,000 cryptocurrencies, and the risk return matrix of each of those cryptocurrencies can be completely different. So if we say compared XRP to say, you know, one of those cryptocurrencies out of those 3,000, we may find that XRP is very stable. The risk return matrix is very stable for the return. It's less volatile and say less negative than say another cryptocurrency. So again, when we say how much we're going to allocate to cryptocurrency, and say if we were a 58-year-old person or a 60-year-old person who has overall assets, say 810,000, you might say that in terms of crypto land, you should only be allocating, say, 5% of your overall to portfolio, okay? If that was the case, you'd be allocating only, say, 41 or 40,000 odd in crypto land, which is only 5%, which is a very, very minimum allocation because of the age, right? So anything over 50, you know, in terms of risk allocation to cryptocurrency, you might say you wouldn't want to lose any more than overall 5% of your portfolio, because at 58, it's very hard to recover if you do lose any more than, say, 5% of your portfolio. And, you know, you have to, obviously, with cryptocurrency, because it is such high risk return, you know, you have to assume that you could lose the whole lot of 40-odd thousand, okay? And again, depends on your risk tolerance. If someone's 58 or whatever, or 50, has a higher risk tolerance and say 5% allocation to cryptocurrency, they might want to increase that to 10, 15. But generally, you know, anything over 20 is fairly high, okay, in terms of risk tolerance for cryptocurrency, given, say, you're over 50 years of age, for example. So probably being prudent, generally, as a rule, probably financial advisors would say 5% or so. And I mean, this is just education only. I'm not giving you financial advice, but probably a fairly prudent conservative financial advisor, if someone was over 50, they would probably say allocate 5% to cryptocurrency only. And then you'd have to go down into what are you going to buy in terms of cryptocurrency, because as I said, not all cryptocurrency is the same. Cryptocurrency will have different return risk metrics and different stability issues and that sort of thing. Again, if you were, say, 35 to 57, because you're younger, you might consider, you know, allocating 10% of your overall wealth to cryptocurrency, which might be 81,000, but that also assumes that you've got 810,000 worth of assets, which also assumes that you've got a property of 625. But you get the general idea, okay? So it really depends on your overall allocation of how many assets you have to how much you would allocate to cryptocurrency, which is a high risk asset. The point being, if you're younger, you can afford to allocate more because you have more time, you know, for something that's negative to become positive, or you have more time to recover. But as you get older, if you're allocating higher risk assets, and if they go bad, you don't have time for these things to become good, okay? So generally the risk tolerance as you get older is lower and lower, okay? So if we allocate to cryptocurrency going forward, what does that mean for an overall portfolio? Okay, generally if we allocate some of the portfolio to cryptocurrency from traditional assets, as I've mentioned before, the four traditional assets that we mentioned, cash, fixed income, property and equities, or slight alternatives, how does it change our risk metrics? And we do find our risk metrics change quite a lot when we add cryptocurrency to that, okay? Allocating to cryptocurrency can make our risk much higher. It can make our returns much more negative or much more positive. It can make much more volatility in returns or risk, or much more volatility in risk and returns, okay? But it does depend on which cryptocurrency we go into, because not all cryptocurrency is the same. Okay, there's also a risk that whatever cryptocurrency we go into, or the basket of cryptocurrencies that make up 5 or 10%, could all go to zero, okay? And it may not be an asymmetric trade-off of risk, okay? So just because you allocate a 1 unit of risk, you may not get 1 unit of return, okay? In other words, if you allocate 3 units of risk, you may not get 3 units of return, or you may get more, or you may get negative. So it's not necessarily an asymmetrical or a symmetrical trade-off of risk return. Hope that makes sense. So if we go, let's allocate, say, 10% of cryptocurrencies to a portfolio. So if we decide to allocate 10% of XRP to a portfolio, or we decide to allocate 10% of BTC to a portfolio, and we look at the returns, historical returns from, say, for Ripple, for XRP from August 2013 to August 2019, or BTC from April 2013 to April 2019. What does that do in terms of our overall portfolio? What does it do to our risk matrix and a return matrix? And how does that improve or not improve our risk return portfolio? I have to say the change is quite amazing. And honestly, it does assume that history will be similar in the future and that risk return will behave similarly in the future. So if you'd like to, I will show you this part of it, but if you'd like to pay for the rest of this in FlixChimp, I'm quite happy to show you the rest of this, and it's very, very interesting if you're interested in further information from this video. It'll only cost you $1.50 or £2 in FlixChimp, but if you want to have a look, if you don't, that's fine by me. So I'll put up those details. Thank you. So if you go to FlixChimp, www.flixchimp.com, author Susie, the rest of this video will cost £2. But also, I'll put an additional bonus video there, a quick update of Ripple and XRP news, okay? Because I haven't done one since basically from the 7th of October to the 10th of November. So I'll also put that up as well. Plus, on this, what I'll be showing in this video on FlixChimp is basically how to calculate these returns and also the Sharpe ratio, okay? So there'll be, quite a bit there. So it's up to you guys whether you think it's worth it for £2 or not. But anyway, thanks, guys. And I hope you're well, looking after yourselves, looking after your animals, looking after your friends, your parents, looking after your animals, looking after yourself, looking after anything that's really important to you, looking after the environment, looking after people in the world, just to make this a better place. Thank you.